Surendra Goyal, Head of Research with Citi, and to talk about the nuances of the macro and the economy, we've got Samiran Chakraborty, Chief Economist with Citi India. Gentlemen, first, a Happy New Year to both of you and thank you for joining us.
Happy New Year.
Yeah, thanks, Nikunj. Happy New Year.
Samiran, now 2020 as a year needs no introduction, and perhaps we've seen all aspects of the economy, a crack, a recovery, discussions on pent-up demand, and now believe that lot of aspects and lot of sectors of the economy, Samiran, are back on a growth momentum. What is in store for 2021? Should we get worried about inflation? Should we get worried about other aspects? Or 2021 could be a smooth year for macro?
Well, you're right, Nikunj, that 2020, as we have seen a massive correction in growth and then almost an elastic type of bounce back in economic activity, which has now taken us close to pre-COVID levels in terms of GDP. And that gives us some optimism that as we move into 2021, there is some tailwind towards growth coming from not just the pent-up demand part, but also what we call the forced savings part, that the actual fall in income has been much lower compared to the fall in consumption, which has led to some amount of forced savings, which in our view will get spent over the next couple of quarters. But what we are really hopeful about is that once this demand kicks in, then we are seeing other kinds of preconditions for a private CAPEX recovery in the second half of the year. We've already seen interest rates coming down, profitability of companies improving, some government policies helping, maybe we get a bit of tailwind from global economy as well. So if all these things put together, if a private CAPEX recovery starts happening in the second half of the year, then that will make us more comfortable about sustaining this growth momentum. For now, we have a fiscal year 22 growth outlook of 11% on the GDP side, on the back of FY20 at minus 7.8%. What we need to worry about is the income inequality part of it. This growth seems to be concentrated in the hands of a few. So unless that income inequality is tackled through a better redistribution mechanism of the government, that might mean that going forward, the growth momentum might slow down a bit. I think that's the bigger worry that I would have.
Surendra, your latest note also seems to be echoing pretty much a take on CAPEX recovery. The fact that not only you've upgraded your Nifty target to 14,000, you've also changed your view essentially on industrials. So for 2021, first, what is the big picture and what makes you constructive on CAPEX stroke industrials?
Sure. So on 2021, I think Samiran kind of spoke about the economic outlook that we expect. And if you take it forward from there, FY22 is a year where earnings growth expectations are already strong, they are already high. And where I think investors have had a lot more comfort is the fact that over the last couple of months, we have seen a consensus earnings getting upgraded. Now, part of it came through cost savings and so on, but net, we have not seen EPS getting upgraded for Nifty in a long time. So that I think is one of the reasons which has given investors more comfort on the EPS outlook. See where we are today, I think the expectations are we will have a strong earnings growth year, partly to do with low base, partly to do with the recovery, some of the points which Samiran already mentioned about. Now, coming to the second part of your question, I think where we are today, we have already seen the recovery kind of play out in some of the consumer-facing sectors. Over the last few months, we saw some pent-up demand and some festive demand. And so we have seen that play out. Now, on the industrial side, for example, we have seen being challenged for a while. So things have been slow for a while, and it does look like that the setup is right. Now, Samiran also mentioned, do we see private CAPEX coming in the second half? That's something to watch out for. But overall, the setup looks conducive, be it interest rates, be it the tax rate cut, which happened some time back. There are a lot of variables which seem to be supportive. And the good thing is that there are quite a few stocks, large cap, in this segment where valuations are still quite attractive in the context of their history. So that is what explains the increased overweight on industrials. So we were overweight even prior to this report, but we have increased our overweight on industrials. And the other part of the market where we have continued to be overweight is financials, where we should see growth improve. And I think the fear of incremental stress is definitely coming down and valuations are a lot more reasonable. So financials and industrials are the two big overweights in our India model portfolio.
Samiran, I'm going to ask a very basic question, which in a sense has been the big question for all of us. The high frequency data points, whether it is GST collection or electricity consumption or what is happening to freight movement, all of them are indicating that the demand is back. Samiran, how does one really differentiate between pent-up demand and sustainable demand, between real demand and what the new word which we use is revenge consumption? When do you think you will get clarity on how much of that is sugar rush and how much of that will sustain?
Well, it's a tough question, Nikunj. I don't think there is an easy metric through which we can differentiate the two. But at least for some of the items where purchasing can be postponed, there it's better to look at YTD cumulative number and take a YTD over last year to get a better sense of how things have been. If I missed consuming in those 2-3 months of stringent lockdown, then I had a choice to postpone my consumption and consume it later on. But for the items where you cannot postpone your consumption, even that metric is not very well valid. And the other thing that I was talking about earlier is this concept of forced savings, where if you look at the first half of the year, the wage cost growth for about 4,000 listed companies is approximately 3%. But in that period, private consumption growth is down 13%. So that is leading to a significant amount of forced savings in the hand of people who are in the formal sector, who have not lost jobs or not lost income. And that forced savings can give you that purchasing power to consume even going forward for next couple of years. So this pent-up demand or additional purchasing power might last longer than what we are thinking right now. And that's why I'm not necessarily becoming bearish that we are reaching a peak on the growth path. But I will hasten to say that the momentum that we have seen in the last couple of quarters, it's almost impossible to maintain similar momentum on growth. So the momentum will slow down, but that does not mean that we will have a double dip sort of situation.
Surendra, ultimately it comes down to what kind of future return we should expect for this year. And the fact that you've got a target of 14,000, it may not look like a very big number, considering that if the view is earnings recovery is around the corner and if you're bullish on banks and industrials, one would imagine that you are baking in an earnings recovery. If that is the case, then why do you have a conservative target for the Nifty?
Yeah, thanks, Nikunj. Great question. So I think the key point to keep in mind here is that the earnings recovery story of FY22 has been known for a while, right? And we have seen the market rally very hard over the last many months. In fact, you could argue that we have seen the market rally from whatever 8,000-9,000 to the 14,000 plus mark on the expectation of a very good recovery. So that, in my view, a lot of it is priced in. And in terms of valuations, whichever way you look at it, all the traditional valuation metrics, price earnings, price to book, the market is clearly high in the historical context, right? On a price earnings, it would possibly be more than 2 standard deviation above 5-year, 10-year mean that the market has traded at. So in other words, a lot has gotten priced in. I think partly what did happen in November, December is we had very strong flows, like $16-17 billion of FI inflows are very unusual in 2 months. I don't remember when it last happened. So that also supported the market in a big way. So I think the market outlook is a function of what has already been priced in and how much has been factored in. And that is the reason why we are a little cautious in terms of the market target. That's the point you spoke about. But interestingly, usually you would see that a market rally is of this kind is led by the high beta sectors, right? While interestingly, this time, if you look at the best performing sectors, they have been IT and healthcare. So in some ways, what has happened is there are sectors which have really rallied and a lot has gotten priced in. And on the other side, there are sectors like financials, for example, where people were very nervous and they are now starting to catch up. So for example, in October, when we raised the overweight on financials a couple of times, we were initially getting a lot of pushback because things were still very uncertain. But as things have kind of become better in terms of the fear and outlook, I think you have seen financials really do well over the last couple of months. So which is where I think when you look at the valuations today and the outlook of the businesses, you actually end up seeing a better outlook and valuation adjusted outlook in financials and industrials. And that is the reason why we are overweight on both those two sectors.
So I'll spend a minute on IT versus financials, Surendra, because it's a tactical trade. IT gives you safety and global growth. Banks give you domestic growth with a promise of little bit of book value expansion for corporate banks. When you say you overweight banks, that means you like banks, despite the fact that most of the banks, at least the big ones, are nearing and record high. HDFC Bank, Kotak, ICICI Bank. So what makes you bullish in banks? Because it's not that banks are cheap right now.
Yeah. So Nikunj, I think honestly in this market, I really can't see too many stocks which are cheap across segments, across sectors. So I think one has to take a relative call. And when you look at some of the corporate banks where our big overweights are, those stocks are still at mean kind of valuation, so maybe slightly above mean. They are now nowhere close to the high level of valuations that the broader market trades at. And for example, in the IT space, valuations are today the highest that you can think of. They are almost 3 standard deviation above the 5-10-year mean. So I think it's a question of what is already getting priced in. So I think that is the key issue, and which is why on financials, as growth returns, as fear comes down, and the fact that there are still pockets where valuations are quite okay, they are like kind of close to median in a market which itself is 2 standard deviation above median. That is where I think financials look relatively okay. So that is where we are coming from. Having said that, I think if you are purely going by valuation metrics, there are very few pockets in the market which are low or cheap by historical standards.
Samiran, I'm just touching on an aspect which perhaps mathematically cannot be calculated, and that is the impact of productivity gains and digitization, work at home, and how it has changed fortunes for Indian IT sector in terms of availability and optimization. Are these factors, Samiran, which you perhaps cannot document in a book, but when the real economy shapes up in the post-COVID world, these are factors which could surprise us and create a lot of upside?
That's quite possible. I mean, there could be, it could work both ways. So let's say first on the positive side, we've seen a significant improvement in profitability in the September quarter numbers for companies. And even if you adjust for factors like travel costs or advertisement and promotion costs, or to some extent even wage costs, there still seems to be a residual element which could be attributed to this productivity improvement. Whereas on the other hand, you could argue that because of all these physical distancing protocols to be maintained in different kinds of services, and in some cases even maybe in manufacturing, there has been a decline in productivity which has led to somewhat higher prices. So part of the reason why inflation has picked up during the COVID period is not just simply because of the lack of mobility issue, but could also be to the companies are being forced to abide by these physical distancing protocols, leading to some productivity decline. So both the things are working simultaneously, but my sense is that over the next couple of quarters, looking at the productivity data and parsing it for wage cost, travel cost, etc., we will have a much better sense of how much permanent improvement in productivity is contributing to this profitability growth.
Samiran, we've got 3 important data points which are different. One, bond yields is at a multi-year low. Forex is at a multi-year high. And we've got fiscal deficit, which we don't know how things will move in the budget. How are these three variables important to judge the health of the economy?
So, at least for the first two that you mentioned, there is a strong element of RBI intervention, which is keeping those two variables where they are. Whereas the fiscal deficit is more in the control of the government to decide where they want to put it. Now, while we are all discussing about the nascent economic recovery, we have to keep in mind that this recovery is to some extent on the crutches of the fiscal and monetary stimulus. And 2021 could be a year when at least some amount of normalization, both the RBI and the government will have to plan for. May not be immediately, but in the latter part of the year, that normalization will probably become a necessity. And that's where these variables will start playing an important role on the economy. That how much of an increase in rate would the RBI be able to tolerate? We are not thinking of any policy rate hikes in 2021, but to some extent, the surplus liquidity in the banking system might get normalized, which means that rates in the system go up a little bit. So we think that 10-year government bond yields can move up to about 6.25 over the course of the year. Whereas on the exchange rate side, the big dilemma is that because we are having a current account surplus, or at least a much lower current account deficit, and huge amount of capital inflows, there is a constant pressure on the currency to appreciate, which the RBI does not want to do because we are simultaneously following a self-reliant India campaign where we're putting some sort of import restrictions to promote domestic manufacturing. So if RBI is intervening so much, that's creating surplus liquidity, which is militating against the point that I was mentioning earlier, that RBI wants to tighten liquidity at the latter part of the year. So how RBI manages between the two is going to be very critical for 2021. And on fiscal deficit, we think it's possible for the government to target about a 4.5% fiscal deficit to GDP in the budget this year, on the back of a slightly lower than 7% fiscal deficit to GDP last year. And that's possible not by so much of expenditure compression, but just by the fact that if the economic growth is normalizing, then the revenue side will improve on the tax revenue side. And on the non-tax revenue side, a lot of divestment proposals which could not fructify in FY21, they might be spilled over to FY22 and help the FY22 revenue collection. So 4.5% fiscal deficit to GDP, in our view, is quite possible for next year.
Surendra, we have had record flows into the market. Record is the word. Sare jahan se acha Hindustan hamara, that's the phase line which we've used to describe what's happened to flows into emerging markets where India has got lion's share. So my question is that if flows continue into Indian markets and if there is disregard for valuation, what should an investor do then?
Sure. So see, firstly, Nikunj, predicting flows is obviously super difficult. I don't think anybody gets it right. Now, I think the thing to keep in mind here is broadly, why are the flows coming? It's largely to do with global central banks, their thinking, as well as a weaker dollar. And at least near term, it does look like that is still set to continue. Okay. Why did India get a lot of flows? I think it's, in my mind, it's partly to do with the pace of the recovery as well as the EPS upgrades which came through, which clearly made India a relatively attractive market. Having said that, I think one should keep in mind that 16-17 billion of flows in 2 months is very, very unusual. So it's not easy to really maintain that momentum or that pace. And to that extent, I'll be very surprised if that continues. So I think if the question is that flows can continue to be super strong, okay, then I think you will see the market kind of looking for ideas where there is growth outlook improving and valuations are still relatively reasonable. Okay, so that is what I think the broad framework for the market will be. And in some ways, I could argue that some of the top sectors and top stock picks we have are kind of aligned to that.